you know, moved way up. Traders try to push it up and failed to get it pushed up, came back down not too far above where it opened for that particular day. So this is kind of one of those you know, traditional candle signals that you would suggest could be a sign of weakness. Secondly, when you're looking at the predicted differences, when we're talking about those, you will note in that same time period, both of those were also turning down. We had a crossover to the downside right here, which was an early alert that this kind of up move was starting to run out of a little of the early steam that it had, and that the intensity of that increase, the strength, had been weakening somewhat, and the predicted differences had turned down. That's a clue that you know, you put all these things together and you have a potentially weak type of situation. Okay, we had then where the candles come down. When we're talking about the candles, where we're looking at what we're you know, talking about, we ended up with these lows, as I mentioned earlier, where we had the candle that got into this vicinity right here around 9:30. If you remember when we had the little bit longer term chart, we said that was an important clue because that's where a previous bottom had been recorded in March 15th, I believe, and we hit that again on May 25th. So you got to regard that as an important point at which something could happen. It's either going to bounce away from there or it's going to go through there. In either case, it could be a clue, you know, from a traditional charting standpoint as to what potentially could occur lined up. We're going to look again back at our chart. We're going to talk about we can get my cursor to behave here. We're going to talk a little bit about what is going on with the market in terms of another indicator that we're going to be using, and we're going to be using, okay, in some case I have not been able to get my cursor to go here. Not sure why. Okay. All right. Okay. I'm seeming to have a little bit of technical difficulty getting my cursor to come in here, and okay, let me see what is going on here. Okay, what I'm trying to do is to get back to my vantage point screen, and let me see if I can do it by doing this way and attempt to get back, but it's not letting me get back into my vantage point screen. Okay, we're going to again do this. We're doing a backwards way of doing this here, and hopefully it'll work. All right. Okay, now we should be back at that vantage point screen. I hope you can see that on there, and you know, we're you know, back where we want to be, because we are going to add another indicator and another couple of lines on here. What I'm going to do first of all, if I'm going to take out that red line, we've kind of done with that. We've used that as a indicator of how strong the Neuro Index is, but we really don't need that anymore. But what we are going to add is a you know, a different method of determining where we want to enter and where we want to exit, and that is the predicted high and the predicted low. The predicted high is that orange line, that gold line, whatever you want to call it there, that's above the price action. The pink line, the fuchsia line, is the predicted low. When you have these particular lines on here, they form kind of a channel, and that channel is the channel that we will use in terms of determining the precise points. Remember, in the other cases, we did not have a situation where we were able to then come at you know, at the prices. We knew the trend, we knew kind of the feeling, we knew where it was going to go, but we didn't really know for sure if that market was, you know, at what point that market we should act to get our precise signals. So now we're going to look at those signals and see if we can't come up with some means of finding a precise spot at which to act. Again, we're looking here at soybeans. We're going to go back here. We're going to talk about the run up, and then we're going to talk about the run down in prices. So we're going to be looking first of all at this particular candle right here. That candle is April the 6th, and the premise of what we're doing here, remember I said we were going to try to use a $20,000 account as kind of our our model for this whole experiment, and we're going to use a risk factor to limit ourselves to no more than 5% of our $20,000 account. In this case, of course, with soybeans being the contract that's $1,000. So we have to make sure that we don't risk more than that in whatever we set up. What we're going to do is when the market breaks above the predicted high, we are going to buy when it is 10 cents above that market. We don't want to get in, immediately after it goes above that predicted high, because as you know, there are a lot of times when you have market jabs and things where it goes up, fakes us out, and whatever. But we're going to use a 10-cent leeway, and so we're going to buy at 9.64. Now, in this particular case, when we were talking about at 9.64, the market, it takes a little while to get there, and I don't know if this is the exact place where we want to put this mark in here, but somewhere right in this vicinity right here, we're going to call that, we're going to call this 9.64 our entry point. And the entry point that we are using at 9.64 occurs on right about there, I think it was, April 17th or thereabout, somewhere right in there where we actually got into the market at our 10 cents leeway. When we look at what we have going on here as to why we would get in and why we would do that, there are several factors going on. First of all, we have a situation, as I mentioned, where we've had the predicted difference crossover. It has moved to the upside. We have the predicted differences that are pointing up. We have the neuro index is at 1. So there are all these things coming together. You can see that the predicted moving average, the blue line, is moving up. So everything kind of lines up that this is a good point at which to take action. And that's why we are buying above the predicted high and trying to find out, if we can hang in this market and try to make some profit out of the move that we are given. Now, there are several different criteria here in terms of where we would like to make sure that we don't take more risk. I mentioned before that we had our predicted high at 9.54. So that means that if I'm talking about, again, I like to trade 3 contracts at a time if I possibly can, but when you look at 3 contracts and you buy at 9.64, that means that if you were allowing your risk parameter to be in place with $1,000, that means that you could only have about a 7-cent adverse move against your initial price, and so that's not very much. It's not enough range. It's probably too close because that puts it at 9.57. And 9.57 is not much leeway in the soybean market when you're talking about a market that can gyrate 20, 30, 40 cents a day. So 9.57 is a little close. So I'm going to have to scale back a little bit what I'm doing, and I'm going to use, in this case, a 2-contract situation, and that means that it would be basically